Welcome to the last webinar for this year. We'll be doing a discussion among ourselves on the takeaways that we got from all the webinars we've been hosting since January up to December 2020. And we also welcome your questions. If you have any questions, we'll be answering that before the end of the webinar. On my team is Gilbert Kimari and Dennis Mwenga and myself, Sylvia Mushai. And the first webinar we held in January, we had a session with a market wizard, Linda Rashke, and we'll just play a clip from her, and then we will get to discuss on what we each learned. So in a bit.
I'm still working on it 40 years later. You're right, you can't ever get rid of a bad habit. Like once you have a bad habit, you can't eliminate it. All you can do is modify it or try and replace it. So, you know, if you have a bad habit of over trading with your hand on the mouse, I have to substitute something else, you know. So instead of my hand on the mouse, maybe I have to have, you know, something else to fiddle with or go through a process of writing things down. I have to do another activity instead of that bad habit. And so then people end up being so harsh on themselves, you know, and thinking negatively of themselves. Oh, I did that wrong again. What's wrong with me? I have no discipline. And you can't be that way, you see? So it's something that we're human and you'll always have to work on. So two things, think about A, replacing it with another activity, and B, a second very helpful thing for you as a trader is to have a buddy.
So the takeaway basically was Linda talking about the bad habits that traders normally have when they're trading and how you can deal with some of those challenges is not really doing away with the entire habit, but replacing it with something else. So I will welcome my co-hosts to add something onto that. So Gilbert.
Good afternoon, guys. Thank you for joining us today. Sorry we started a little bit late. So with Linda Rashke, what I got from her, because we just played a small clip and there were other clips as well, but what I took from her interview was the aspect of risk management and also trading psychology, because it's something that I noted down, and in fact, if I can just read it for you, the first step to being a pro trader is knowing that you can make back your money after making a big loss. In order to make back a big loss, you need to reduce your anxiety, settle back or settle down both mentally and physically, and don't dwell on the past, but look towards the future. So being able to recover from a bad loss, you know, that can really motivate you. Once you know that you can actually recover from a loss, you know, you no longer need to fear making losing trades, because I think once someone makes a loss, you know, you start becoming very fearful, you start doubting yourself, start wondering, you know, is there anything wrong with you? You can really look down on yourself, especially in trading, because you have to know how to handle these losses. You have to know how to take these hits and be able to recover from them. So what I learned from her is just that aspect of being able to recover from a loss and the kind of confidence that can give you, so that approaching other trades, you no longer need to fear making a loss. Because if you fear loss, then you'll fear trading. But if you don't fear losses, then, you know, the sky's the limit for you.
Thank you for that, Gilbert, and thank you guys for being here. So one of the bad habits, for example, I can talk about personally that I used to have when it comes to trading is moving stops. It's common with everyone likes to move stops, and basically this arises from the feeling or desire of not wanting to be wrong on a particular trade. So you find yourself that you set a stop loss of, let's say, for example, 10 pips. Then as price trades near your stop loss, you say, well, I can try to adjust it a little bit. And the habit tends to become repetitive, but at the end of the day, you realize that it's not making any difference, because if the trade was going to be a losing trade, it's going to be a losing trade. So if you had sized your position well, let's say, for example, your lot size, as Gilbert was saying, applying risk management, you should be confident that, well, with the risk management strategy that you're applying, that means having that stop loss on, it's going to help you in the long term. So it's going to help your bottom line, and you have to accept that fact, that reality, instead of moving your stops around. Because if you had a stop loss at 10 pips, then you move it below or above, let's say by 5 pips, for example. That means that you are violating your rule, your trading rule. And one of the things that Linda Rashke also said in the video, you can have a buddy, okay? You can have like someone when you are trading to basically tell you and point out that what you're doing is a bad habit. That is why guys have mentors, for example. That is why also guys trade in teams. You don't necessarily need to have a mentor, but also as you trade with a friend, and you don't have to really be putting on positions together. You might be having totally different trading strategies for both of you, but both of you being respecters of risk management, then you can be able to check one another when the habit arises. So keep a buddy in hand. Some people have mentors. Some people are in community groups, trading support community groups, whereby they get to discuss this thing. Always talk about it as a challenge, and you will overcome such kind of a habit. Personally, that is what helped me, because I told you guys that was one of my bad habits, moving stops.
All right, and I can also conclude with Linda's interview. If you happen to have like a bad habit that causes you to eventually have like a losing week or a losing streak, you don't need to stay on that negative feeling of, you know, you have really lost money, and that self-pity. It can make your matters even worse. So when it comes to how you deal with the markets, try and isolate yourself from how you're feeling. And like my colleague has said, if you happen to have like a trading community, as Scope Markets normally encourages, it's good, because then you will be not operating from your head space. So yeah, so and then the next interview, we had one with Jeremy Newsom. He was very lively, and his manner of explanation in terms of trading stocks was very easy for anyone to understand. And I can remember when he was talking about how to invest in stocks and how to own, become a shareholder basically. So I'm gonna play a clip for Jeremy Newsom, and then we can listen from what we took home, and then we will discuss. So before we start, Jeremy Newsom basically trades using credit spread.
When people buy more of a company, what they're doing in essence is that company receives more money, right? And when a company receives more money, they reinvest it into their company, right? Hire employees, buy buildings, research and development. All this money is coming in, they're doing things with it. So what does that do? It grows the value of the company, which does what? Grows the value of the stock, right? It's just like, holy smokes. Okay, so I can buy a newer company, a newer age company that's growing, that's doing something great with their money. And if I buy it at a good price and I hold it long enough and I research the company, there's a strong chance I'm going to win. And the answer is yeah, and you can win large. That's incredible, because you're owning a piece of a company that's churning and burning. It's making money while you sleep, and that's how you become wealthy.
All right, so that's part A. Let's see what else he had to say, and then we can comment on that.
So when you first start out, I would say really aim for 2 to 4% a month. That's reasonable. It's realistic. It's doable. It can absolutely happen. And 2 to 4% a month is still quite good. I mean, if you're doing 4% a month, that's 48% a year. If you don't pull any money out, I mean, compounded, that can be insane. This is what I try to obtain. It doesn't always happen, but that's just one of my goals. And that's a combination of many things. So this 10% a month, right? This is a combination of many, many things. This is day trades, swing trades, option trades, long-term investing. This is a nice blend. I really strive.
So yeah, I welcome my team to comment on Jeremy Newsom. Then
I liked Jeremy's interview. I would say that I think that was a very good start for our year, having Jeremy on board for, I think that was the second interview that we had. And what I liked about Jeremy is his strategy was very simple. And just like you've had, he was very precise about all the criteria that he has to look for before he makes a trade. And that's the thing, if you have a strategy, it's supposed to be well defined. You have to have a well defined strategy and you have to follow it to the letter. And you could see him detailing it, So first of all, he looks for a stock that's trending well over a short period of time. So that could be like a few weeks. Then he looks at the candlestick patterns to be able to tell what story the candlesticks are telling. And that is true. And you'll hear this with a lot of professional traders talking about building a narrative before you trade. So you have to build a story. And just like he said, it's a movie, and if you follow the movie, you're able to understand what was going on. And you can also be able to predict what is likely to happen next. We do that a lot, even when we're watching movies. You can just tell the narrative, how things are going, and you even start predicting how it's likely to end. So the importance of building a story or building a narrative, and also sticking to your rules, not skipping one rule just so that you can get to the other because you're desperate to make the trade. And a lot of trading is actually sitting on your hands. It doesn't mean that every day you have to trade. So you have to ensure that you follow all the rules that you've set for yourself. Then something else you also mentioned to do with the returns. And this is a question I think we got so many times during the year when we were doing the interviews. What is the likely return for a trader? And he detailed it in 2 steps. He said that for a starter, if you're starting out in the market, and Jeremy actually trades, I believe, was it trading Forex or it was mostly stocks? I think he was trading mostly stocks. And he was saying that for someone who's starting out, between 2% to 4% is what you should be targeting. And Scope Markets does give you stock CFD, so you can be able to trade US stocks and European stocks. So targeting about 2 to 4% per month. Now that looks very low, but here's where the aspect of risk management comes in. And also remember the kind of stocks that we're trading, that we have access to, are the large cap stocks. The ones that are either in the S&P 500 or the Dow 30. A little bit of them are in the Russell 2000. So that means the kind of movement that it can give within a day is not that great. So of course you're not going to be able to make as much money as, say, the ones that we call return in a month. And mind you, with the power of compounding, 10% a month for even 10 years, you'll have outperformed all the other investment companies out there in the world, because even some of the best were doing about 60% in a year compounding. So if you're doing 10%, that's about 120% in a year. So don't look at those figures as being too small. A month, sorry.
Actually, Gilbert has covered basically what I wanted to talk about, and I basically wanted to say being realistic about returns. It's very important to have that as a takeaway from that webinar. And according to Jeremy's trading strategy, clearly he's a short-term trader, and he's a short-term trader who has specialized in trading the open. That's why when you hear him talk about his trading strategy and how he breaks down his methodology step by step, looking for a good trend, a trending stock, probably a stock also that has a news catalyst behind it. That is why he mentioned and said all this COVID thing that is currently ongoing. And then analyzing those stocks individually using obviously candlestick methodology. So it's mentioned options, and also closing some futures also in his trading, in his portfolio. And out of all these things that he trades and trades them actively, you can see that he manages to reap a return of around 10%, for example, in a month. I'm assuming he has leverage and also a return ranging between 5 to 10%. So even if you are an active trader, the point is that even if you are an active trader, you have to be very realistic about the returns that you're going to crunch out of the market. And you also have to be very cautious when you're trading, especially when you're day trading. That means that you're looking to be taking very small risks. You're not looking to be hitting too large, which is gonna be a good thing in the long run.
In the same breath, when we're talking about stocks, I'd like us to hear from Fred Scott, who was basically a fundamental analyst and also an investor in stocks. His presentation was mostly about value investing, and the takeaway for me was when you're investing in stocks, you need to invest in something that you know. And his criteria for selecting a portfolio is that if you can research for companies and you know the companies in and out, then you can invest in those companies. So we'll play that and then we will take away from Scott.
Now, when it comes, you were asking about metrics, so I guess this ties into it. I prefer cash flow because it's one thing that is really hard to mess around with accounting wise. Like equity is really simple to screw with. For example, if you own a company and you hire 10 people, that comes out of your cash flow of operations. It goes into your equity, right? So you're taking away from your equity. So if at the end of the quarter, you're supposed to earn $1 in earnings, after you pay all your workers, you only have 20 cents in earnings. What a lot of companies do is they just fire a bunch of people and it makes the equity number go up. So it artificially inflates the earnings per share. And a lot of, there's nothing illegal about it. There's nothing weird about it. It's just the way business is done. So there are numbers that you can manipulate in accounting. Earnings is definitely one of them. Cash flow for operations could be manipulated, but it's much more difficult to do because you can see what money goes in, what money goes out through the income statement. So in my opinion, the most important metric is cash flow. And a company can have whatever earnings they want, but if they're not selling anything, there's no cash flow. So that would have prevented people from getting screwed with something like Enron or something like General Electric or something like that. Like you would have seen that coming if you would have been paying attention to the cash flow because there was no cash being generated. But for some reason, the earnings kept going up every quarter. So that kind of leaves you wondering, like, why is this happening? Investors didn't care because they just saw the earnings per share go up every quarter. But if you paid a little bit more attention, you would have seen that the cash flow was going down every single quarter. And that would have been like a good tale. It doesn't always work, but it will keep you out of trouble for a long time.
Yeah, that makes sense. Cash flow. I think cash is king in so many ways. And what comprises a good stock portfolio for your long-term and also for your short-term trading while you're trading stocks?
I look at it as do you mean for a personal basis or professional basis?
For your professional trading, yeah.
Well, because I would give a different answer for each one. So professionally, the stock portfolio that you have should be dependent on how much research you can do. So if you can do research on 20 companies, then that's what you should have. If you can do research on 1,000 companies, like Peter Lynch used to do, then that's what you used to have. That's what he should have. So there's no right or wrong when it comes to a number. There's people like Bill Ackman that only have 10, 12 stocks because that's the research that he put into those 10 to 12 stocks. So it doesn't really matter the number that you have, just how much of a research arm do you put behind it. And when it comes to personal, I don't like to separate investments from the rest of your life. So if you have any kind of credit card debt or anything like that, I would include that with your overall portfolio. And the more debt you have, the less of a performance your portfolio is going to have. So you have to figure out a way to like bring down your debt, and then you can focus more on investing. But let's say you don't have any debt and you want to invest in stocks, then you can do the same thing. Get as many stocks as you can research. So if you can only research 4 or 5, only get 4 or 5.
Yes. So with Frederick Scott, what I got from his interview, and it was quite an interesting thing. Generally, we tend to concentrate on the earnings reports. That's how you tend to see it even online. People are looking for the stocks that are having some form of earnings report that is coming out. And there's that assumption that if the company has projected that, they're going to pay out a dividend, or that, they seem to have made a profit, then everyone usually just jumps in on that share. However, you need to be able to investigate a bit further, because there's some shares that are being inflated. There's some stocks that are being inflated. And you just find people, they're coming out, the earnings report is coming out, it means that they're going to pay out a good dividend. People jump in on that stock, they start propping it up higher. And a very good example was like Enron, which this was, it went bust in the early 2000s, I believe. And they were at some point doing oil, and they were trading some oil. They used to be in oil, and you couldn't even be able to understand exactly how they were making the money, because it was a very weird thing. And people just jumped in on it because it was the hype of the day. And it's very important for you to understand cash flow. How is the money being made? And this is something that you also see from Warren Buffett. And the reason as to why he didn't even invest in crypto, he said that if I cannot understand the underlying value that this asset or this service is providing, then I cannot invest in it. So if you cannot understand how the money is being made, then chances are there's no money being made, right? So you have to be able to interpret. And that does mean, having to study a little bit of accounting as well, so that you can be able to read these financial statements and understand. So that's a challenge that I'm going to pose to you as traders who want to get into stocks. You have to now start, if you don't have an accounting background, you may need to start reading up, just so that you're able to understand how to read these financial reports or these financial statements, so that you can be able to see where the value is. If there is no value, you can be able to tell earlier on. So that is his most important metric. And it's something that has been echoed by a lot of traders. So for me, I took it seriously, and I also started polishing up on how to read financial statements for a company. And we can even start with our companies here in Kenya as well.
All right. And then we will switch to energy traders. So we had 2 lady energy traders. One was Tracy Schuchart. She primarily trades oil. And the other one was Bryn Kelly. So we got to ask them about how their approach towards trading oil, the difference between WTI and Brent. And in the interest of time, once we listen to these 2 ladies, I think we will give our takeaways. We'll have a discussion with Gilbert on each trader so that we can save time, and also for the sake of those people who cannot hear the audio interviews. So let's just get the difference between Brent and WTI from Bryn Kelly, and then we listen to that. To Tracy Schuchart shortly.
WTI is the benchmark for US crude oil, and Brent is the benchmark for oil in Europe. It's the North Sea area. One of the big differences between the two is that WTI, the delivery for that futures contract, is in Cushing, Oklahoma, which is several hundred miles inland. So it's called a landlocked contract. In that way, it has to be moved via pipeline to the coast in order to get it on a ship to export it. Brent, on the other hand, is priced as a waterborne cargo. So it's considered production in the North Sea. And in that way, it has a little bit of an advantage in getting itself to global demand markets. And, as the US is now, we now export oil, we're competing to move our oil into, the Middle East, into China, across, quite honestly, Africa with their, West African Light has been for a long time a huge competitor, big supplier to the US, and now, we're in competition, and it really all comes down to who's closer, because, it's transportation costs, right? You got to load it on a ship, and, it costs a certain amount of money to get it to Europe, costs, twice as much to get, to the Middle East or get, to China. And in that way, whoever is the closest.
So, how the oil market works, there's two basic benchmarks that trade, right? You have the Brent contract, and that's mostly a financial contract. It's not a deliverable contract. So in that market, you'll have a lot of people that are hedging and things of that nature because it's a financial product. On the other side, we have WTI markets through CME, and that's actually a physically deliverable contract. So they both, you both see them move together, right? They rise and fall kind of together, but how they're traded is completely different.
Yeah, so what would you take from that?
What I'd say, especially with Brian, is it Brian?
Brian Kelly.
With Brian Kelly, I had always wondered about that spread that exists between WTI and Brent. And in most cases, Brent trades at a premium over WTI. And over the years, I used to look at the two charts side by side, and I could see that maybe Brent is trading at a premium of about, there was a time it was about $10, a $10 difference from WTI. And I couldn't quite tell exactly, or I'd never gotten a good explanation as to why that is the case. So with Brain, at least I was now able to understand that, it's all to do with logistics, the difference between that price. When you look at Brent, it's a North Sea oil contract, and it's deliverable in the North Sea. So it's already in the ocean, and oil is transported using tankers, these oil tankers across the ocean. So it's much easier for you to buy your oil from the North Sea because it's already in the water, in the ocean, than it is for you to get your oil from US. Because if you're trading the WTI contract and it's deliverable in Oklahoma, so that's where the oil is delivered in Oklahoma. So it still has to be piped all the way to the coast. Then from there it's shipped. So there is a cost aspect to it. And that was quite enlightening, being able to understand the difference between those two contracts. What I also took from that was Tracy, is that WTI is deliverable, like you have to take delivery of it. And that also now makes us understand as to why the oil prices dropped, and they even went negative during, I think it was around April of this year, because people realized, like the people who are taking delivery in May, realized that there was not enough storage. So you're taking delivery of the oil, yet you don't even have a place to store it. And that's the reason why there were no bids for it. And the prices just went, even negative during that period. So at least now being able to understand a little bit more about the oil market, and it's thanks to these two ladies.
Yeah, I think Gilbert has explained it very well. And right now, I think what we can do, we can go through our takeaways individually, have a discussion. So we can start off with, for me, Peter Maish. Peter Maish really focused on the process. The idea behind trading is to focus on the process, because when your focus is lost on, say, the P&L, that is your profit and loss statement, you might end up losing or experiencing drawdowns in excess because you're not focusing on trading right. So he was basically saying that your focus and your concentration for you to achieve consistency and longevity in trading should be focused on the how to trade right. And I think you can comment on what you got from Peter Maish.
Yes, from Peter Maish, actually something that is common throughout all these guests that we had is the aspect of risk management and trading psychology. They each have their own trading style. You know, they're quite different in how they approach the market, especially when they would share their charts, and then you'd be able to see even the kind of indicators that they're using or how they understand price movements in terms of the technicals. But when it came to risk management and trading psychology, it was the same thing that was mentioned across the board. So for Peter Maish, in fact, I wrote something down. Reality check on the market is to stay on your own lane and not to get caught up in chasing the money, revenge trading, or competing with other traders. Learning how to take a breather from a bad trading day is important, especially for your personal life. Try as much as possible to concentrate on the process. So it was all about the process, and we can get caught up in the losses. And I think it's quite common here that the thing that usually impacts trading psychology the most is the losses. You know, so you can get caught up in that loss, you know, it ends up giving you a bad day, you end up being mean and aggressive to people around you. They don't even understand, you know, why you're so moody. So being able to just concentrate on the process, you know, what you need to do, the next step, and try and block out all the noise in terms of losses, in terms of profits. And if you look at some of these professional traders, they look at it as a game. You know, it's not a life or death scenario. And unfortunately, a lot of traders who are starting out usually look at trading as a life or death. You know, you have such high expectations for your trading, but in actual sense, it's supposed to be a game, right? You're supposed, and if you look at games, it's all about getting to the next stage. This stage, next stage, next stage. It's all about next, next, next. It's not about, you know, getting caught up in the emotional turmoil of one stage that prevents you from getting to the next stage. So that's what I got out of Peter Maish, and it's kind of a common theme across all these interviewees that we had, or guests that we had.
Yeah, I do agree with that. And we had another guest because you mentioned trading psychology, and one of the best minds, along Wall Street on psychology is Brett Steenbacker. So we were fortunate enough to interview Steenbacker, and for me, what I got from him, and guys, I have linked our YouTube channel where you can go and listen to all these interviews on that link. Just Google Sylvia's Traders Lounge Forex channel. All the interviews we did from beginning to end, from minute 1 to end, are on that link. So for Brett Steenbacker, what I got from him is that we need to have very clear-cut goals. What traders do sometimes, you tend to have too many goals, and when you have too many goals, he said it's as equal as having no goal, because then your goals are not actionable. So I'm going to read what I got from him. That is, turning goals into specific and actionable plans is one of the best practices for successful traders. And the key takeaway is not having too many goals. Have goals that you can wake up every day and have like an action that leads you closer to your goals. And also, just finalizing on that topic of having the right focus, I remember Akil Stokes, we had him, I think, in April, and the topic was investing in self as a retail trader. He was basically saying that the mistakes that he made early on in his trading was that he was focusing on getting the magic formula, what people call the holy grail. And so that deterred him from finding a basis into his now methodology of trading, which is based on price action. So he said that the wrong focus was on finding the magic strategy which deterred him from actually knowing how to trade, focusing on the basics of the trend, reading the price and technical analysis. And that is a mistake that we find ourselves in as beginning traders, where you're hunting for entries and stops and exits, and really you haven't gotten the rationale for why you're placing or why you're entering at that specific price point. So it's very important for you to understand the underlying principles of trading, underlying strategies, and before actually going right to the markets. And we normally actually say that before you go full on a live account, try and test your strategies on a demo account and focus on understanding the basics of trading first. So maybe you can say something on Akil stocks and Brett.
Yes, maybe I can begin with Brett. And I think, there are times I have those periods whereby, you have a very good strategy and, you just want to kind of stick to that. And it's a bit of a, it kind of clashes a little bit with what Brett was saying and what Akil was saying. Because when you now finally stabilize on a good system, it's all about all the ideas that you get, you're supposed to ensure that you're using them to build on your existing strategy, not really developing an entirely new strategy. And in that case, they were both saying the same thing. So for Brett, you're saying that some of the key traits, or what I got out of it was some of the key traits of successful traders is, number one, the ability to see an opportunity and develop it into a sound trading idea. And that means you need to be curious as a trader, right? You need to be a bit curious. You need to be able to look at things and try and see how you can make sense of it, or how you can be able to incorporate it into your already existing strategy. And other than that ability to see opportunities and develop sound trading ideas, also being able to pay close attention to detail, because it's all in the details, and being able to, again, control emotional reactions. So you can see that theme again about trading psychology, the ability to control your emotional reactions. With Akil Stokes, what he said about, why he had such a rough time. First of all, he thought that he was doing, he knew what he was doing up until he got challenged, to talk about a trend, So someone asked him, where's the market going? And he couldn't be able to tell whether the market was bullish or bearish. And that's the time he realized, that he was toying around with ideas, or whatever it is he was doing was almost like guesswork, because if you can't tell what kind of a market structure that you're in, are you in a trending market or a ranging market, then what exactly are you doing? And I also got caught up in that, starting out chasing these holy grail systems. In fact, there's even a system called the holy grail system. And if you even go through it, it's not really a holy grail. There's nothing perfect. And, that's the folly of a trader, always looking for, this mystical strategy that is 100%, it has 100% success rate with a risk reward ratio of 1:3. Your profits are always 3 times your losses, and you never even get those losses. So this is, a fool's errand, but it is still important for you to be curious, to test things out. But the moment you get something that works, concentrate on it and try to build on it. Don't go chasing so many different systems all the time. Just because you've made a loss from one, you now discard that strategy. You start trying to come up with a new strategy. Have an underlying principle for what you do. Then what you can do after that is add on to it. So this is where now you can develop new ideas, being able to see new things in the market that you never saw, and being able to take that and incorporate it into your trading strategy, but not switching strategies all the time. If you do that, then, years later, because I've met traders who are like this, years later, they still don't quite know what their strategy is. One day they're doing this, the next day they're doing another thing. So that is very important. And with Akil Stokes, he had a 4-point strategy for identifying his setups. Again, notice that attention to detail and the structure for your strategy. You always follow through. You have a clearly defined strategy that you follow through every single aspect or every rule of your strategy without fail. So that's what I got out from Akhil Stokes and also from Brett Steenbacker.
Yeah. And then I remember the interview we did with Stephanie Kammerman. Gilbert always quotes that lady whenever we have discussions about webinars. And her secret, basically, because she's an author of Dark Pool Secrets, she said for her, you know, she didn't go to school to study about the stock market. She didn't go to, you know, she started out by just being in the right place with the right people and learning from the best. So basically, she was able to decipher how market makers manipulate the markets and have a print for following those dark pool prints in the markets. So, but for her, her emphasis was that you really cannot learn how to trade just by picking up a book on Wall Street or whatever book and learn how to trade. So to shorten your learning curve, if you really want to be a full-time trader, is to align yourself with people who are actually trading, people who are able to give you, you know, time to observe what they're doing, and that way you can learn faster. So, and then also Gilbert had said something to do with the Holy Grail. And I remember a trader called John Locke. He's a psychologist, trading psychologist. And the theme was how to make great decisions and sound decision making. And it all comes down to your emotional stability and how your brain works. So he said that, you know, the market is basically ruled by emotion. He called it an emotional machine, where the movements in the markets reflect the thoughts and ideas of people's action in the market. So he says that motivational factors that drive all human being behavior is the tendency to avoid pain. Say, for example, if you lose money, you don't want to feel that pain. Tendency to seek pleasure and to conserve energy, which is why guys try to go looking for a holy grail, which does not exist, as Gilbert has said. He called it also the magic strategy in the markets, and people focus on the wrong things. For example, they focus on the perfect indicator. And when they focus on those things, they are trying to avoid putting in the work. So we go back to the foundation. Do you understand how the market works? If it's the Forex markets, do you understand the concept of the trend? You know, so there's really no shortcuts. You have to put in the work. You have to learn from someone if you don't know how to trade, and that is a good step to start. So maybe you can say something about John Locke and Kammerman, your favorite.
Yes. Actually, with I think it's a colleague of mine who was saying that I was blushing during that interview with Stephanie Kammerman. But in actual sense, I was quite impressed. I was quite impressed because I had heard of this dark pools, or this concept of dark pools, and I didn't know that it was a lady who had, you know, popularized this kind of trading. And she really went into a lot of detail about how they're able to identify. We used to call them at some point. We used to refer to some of these things like, you know, the dark web of trading. You know, that like there's a hidden market where the big players usually position themselves before they move the market. And it was always like a conspiracy because no one could actually tell exactly how this works and how you can get access to this information. So it was always like a conspiracy theory for quite a number of years. And then, you know, we meet Stephanie Kammerman. She comes on a webinar, and you know, she gives us a very clear picture of what these dark pools are all about and how these big traders usually position themselves in this. I think she was calling it the ETF markets. I believe it's in the ETF markets, whereby the ETF funds, sorry, these exchange traded funds, whereby you could have a fund that has grouped a couple of shares, a couple of stocks shares into the fund. And what they would do is that they would use that as a way of stacking up orders on a particular stock. And because they have about 24 hours to disclose that information, once they've been able to push in as much orders or get in or get out of that market Once they've been able to do that and do what they wanted to do, then after that, 24 hours later, they can disclose that information. And because most of us don't even know about this information, we're not able to use that as a trading edge in trading stocks. And I remember during the interview, she was talking about gold. And this was before gold went beyond the $2,000 mark. So it had a resistance of about about 1,900. That was like its all-time resistance of $1,900 an ounce. And she was saying that she had been seeing a lot of dark pool activity in and around gold. And she was expecting that it was going to break that resistance. And sure enough, later on in the year, it did break that resistance. It went even above $2,000 an ounce. And this was quite interesting because this is something now new that I came to learn. So I also realized that when it comes to learning, even if you've been in the industry for years, there's always something you don't know. And the moment you you come across it, then it's now up to you to investigate further and then see how you can incorporate it into your trading. So that was Stephanie Kammerman. And also something else I got out of her interview is how she runs her trading group. And if you follow her on Facebook or on Twitter, every week she usually posts like the trader of the week, the one who gave like a really good trading idea for the week in the stock market that benefited the entire group. So even the whole purpose of building communities or building trading communities, it's not just, sometimes people view us trainers as, oh, you guys are just there for training. The real premise behind going and trying to impart knowledge on people is so that you can create a community of like-minded individuals, so that these guys can then get empowered and go further than where you've taken them, and come back and also offer value so that the entire group benefits. And that whole thing about community, being able to share information with each other, being able to grow together, to the point whereby, yes, there's the person who introduced you into trading, who even showed you the key strategies of trading, but in that group, you can't even tell, who is the father or quote unquote mother of the entire group, because everyone has the ability to do their thing and do their thing confidently. So that's what I got from Stephanie. Now, with regards to John Locke, wow, I think with regards to psychology again, what Sylvia said, the motivational triad, he called it a motivational triad, that set of emotional factors that drive all human behavior. Now, remember that this market is all about human behavior, and the people who understand human behavior are the ones who thrive, because the market prices are moved by irrational behavior. So the markets are not moved by rational behavior, they're moved by irrational behavior. So if you can understand this irrational behavior, then you can be able to find some kind of a trading edge. So it's good to get that confirmed by these trading professionals, people who've been in the industry for decades. And there's something else from John Locke regarding risk management. And I jotted down something here. So he said that, or what I got from this is, risk management with regards to position sizing is all about how much the trader is willing to lose, and not about how big or small the account is. Neither is it about how much money you want to make. Position sizing is also going to vary depending on the amount of capital and the trading approach taken and the objectives for trading. So risk management is not, position sizing has nothing to do with the size of your capital and also how much money you want to make. Whenever you're approaching a trade, or when you're crafting your risk management principles, it's all about how much you're willing to lose. And I believe this was also stated by another guest that we had, and I'm trying to see where I had put his info, and he's an automated trader.
Matthew Tucker.
Not even Matthew Tucker, Mr. Ritabrata Bhattacharya, and he was also talking about this. When it comes to risk management, it has nothing to do with how much your capital is, just coming up with random figures. It's all to do with how much you're willing to lose. So that figure that you're willing to lose, that becomes the figure that you mark as your overall risk for any given trade. And that's how you're supposed to see it. So it's not some fancy numbers that you get online, your risk is supposed to be this, it's supposed to be that 1%, 2%, 4%. It's very difficult to interpret that. So you'd rather interpret it in dollar terms. How many dollars are you willing to lose on any given trade? Once you can be able to answer that question, then your risk management strategies can begin now developing properly into something solid.
Yeah, and I remember Rita Brata because I watched his interview. I was away when Gilbert was hosting Rita Brata. And so going through that interview, the entire interview, he was talking about adapting as a trader. So trading has come a long way. The markets are uncertain, they keep on changing. He was talking about the phases that the markets have, changed. And, he talked about the way initially it was all about fundamental analysis. So the likes of Warren Buffett taking a stock and holding on to a stock for as long as he can. And then after that, it moves to chartists, where people now started analyzing markets from a point of chart patterns and just looking at a chart, the price differentiation between prices. And then the markets now shifted, where hedge funds and quants decided to start using analysis, so analytical tools to determine where the price is going. So nowadays, we cannot ignore the development of algorithms in the financial markets and what the HFTs, the high frequency traders and market makers use. And so being able to take data and analyze data from a point of understanding the market is very important, because then if you do not adapt as a trader, at some point you will be left behind. And so you should be able to look at your trading strategy and ask yourself, will this be relevant, 5-10 years from now? And he was talking about how his risk lab, he calls it true risk lab, what they do is that they use artificial intelligence and machine learning to find a trading edge. So if you're really looking into someone who is a programmer and is, using automated trading strategies, you can go to 2 interviews. That one for Rita Brata. The topic was basic fundamentals of risk management for the retail trader. And also to Matthew Tucker. Let me just get the topic for Matthew Tucker. He's also, yes, it was using Python. For Matthew Tucker, he was a programmer, he uses Python. He is strictly a systems trader based in New York. So we cannot deny the future of finance, it's automation. That doesn't mean that you really have to go away or step aside from your trading strategy, but being aware of the developments and the trends in the financial markets, it's really vital. And tying into that, let me just add on to a trader called Anka. And she was an investment banker first before she went private to manage her own fund and start her company called Trader Cloud. And she was also talking about how algorithms, thrive on small time frames. As a day trader, she's a day trader and also a swing trader. And the key from that is that you can be both a day trader and a swing trader. A lot of us tend to stick to one trading style and we think that we cannot do both. So she was giving the difference between being a trader and being an investor. And let me just quote her: as a day trader and a swing trader, flipping to different time frames would call for having separate trading accounts. So she has 2 different trading accounts. And also, sorry guys for tying so many people, time is not on our side. Michael Tedeschi also talked about the difference between trading and investing. And he said that for Michael Tedeschi, and this is a guest that we interviewed after coronavirus had kicked in March, April, and he was talking about how to cushion yourself against the pandemic. And so he said, when we asked him about the difference between trading and investing, he said that, he was using, the major key difference between trading and investing to novice traders, using gold to hedge and cushion investors against inflation and impact of coronavirus. I think, Gilbert, you can add on to Tedeschi and Anka.
Maybe I can reference two other traders, maybe due to time, and that is our very own Naomi Wangare, who is a Kenyan trader, and she was talking about the journey into trading and how she also started out, by just going online, trying to figure out her way around the markets. And I think a lot of new traders usually begin like that. You first of all go try and do the trading yourself. And she was mostly talking about the importance of having a mentor. And I think that has been stressed by so many other traders, that there is that importance on having a mentor, because a mentor is going to reduce, or is going to shorten your learning curve, and you're going to end up avoiding so many mistakes that a lot of traders end up making, and that is, you losing your money. And most people who started out without mentors, the key thing that they'll tell you is that they ended up losing a lot of money. And most give up, but then there are those few who end up, just continuing through and pushing through it, and eventually they reach out to someone, and that person who's more experienced than them usually now takes them through what they were doing wrong, and then now gives them proper direction as to what they're supposed to do correctly. And it is good to hear that also from a Kenyan trader, that yes, she does value the importance of getting a mentor. And it's only when she got mentored by the team there, AfriForex, that's the time that now she really started gaining her trading edge. And based off of our presentation, it was more so to do with support and resistance, being able to understand how to trade in and around support and resistance. And what I took away from her interview was, to be successful in your trading, you must have a good balance between greed and fear to ensure that you stick to the trading plan that you have created. Again, you can see even from a Kenyan trader, the importance of risk management and trading psychology. So this is something that you will see through and through, that you need to ensure that your risk management is correct, or at least your risk management is sustainable, and you also need to have a control over your emotions. Also, another guest that we had, Jen Galena, and what I got out of her interview was to do with the importance of a watch list. Now you hear about daily watch lists, being able to analyze the market, first of all, identify the markets that present the best opportunities, and then you stick to those particular markets. So you just go eliminating. It's a game of elimination up until you settle on the markets that have the best opportunity for success, or the highest probability of success. So she was saying that when analyzing the daily watch list, now for her, she even detailed exactly what she looks for as a stock trader. You look for stocks that have a pre-market volume above 100,000 shares. This is something else that we have seen with other traders, saying that you look for markets that are trading, that have a high volume. And this is specifically for stocks. So you need to be in a market that is very liquid, because these markets that are not liquid means that it's very difficult for you to get in and out. And I usually give an example locally here. It's like the difference between trading Safaricom shares and maybe trading a company that's not traded so much, but it's part of the NSE, and that is something like Kenya Orchards. I think they're still there, or Home Africa. So if you look at those stocks, they barely move. The amount of volume traded in a day can even be less than 1,000 shares. However, when you look at Safaricom, it's in the millions. So you'd rather participate in a market that has a lot of volume, because it means more trading opportunities, and also being able to get in and out of these transactions quickly, because again, you don't want to be stuck on a trade. So maybe, I don't know your thoughts on that.
Yeah, just to it may sound cliche, but for me, what I got from Jen Galena, she was talking about how her day starts as a full-time trader and a mother of two. And part of her morning routine is, of course, working out and feeding her body right, because then the amount of energy that is consumed by staring at your charts every day would need for you to nourish yourself with the proper nutrients. So just going back to balancing your life, and at the end of the day, you're a human being. Even as a trader, you want to trade for the long term, and that calls for you not neglecting your health. Very important, you know,
And also
as we
maybe,
go on. Yes.
and also to add on what Sylvia has said about Jane Galena, I can say that there's something I got from Anchor Metcalf about finding that balance in your life. And you find that a lot of times as traders, we tend to, when you're starting out, when you're trying to find your balance, you can be all over the place. At times you can decide, you're not going to have any time for your family because you're stuck on this trade, or you're stuck on, a particular target that you haven't met. It can really impact on your trading, on your personal life. So there has to be a balance between your trading life and your personal life. And what Anka said is, there's that importance of finding balance between your trading and personal life. Most traders seem to merge the two together, but there should be a life beyond your work, and this will help you to that will help you to have enough time to energize and do other things that you also love to do. So you treat it like a business. Trading is supposed to be a business, and that means you've set the particular hours in a day for it. So if you normally have maybe your trading day is 3 hours or 4 hours, that's what you commit to. You commit those 4 hours fully into your trading, and after that, you leave it. You separate that from your personal life. It's just the same way if you have a job, you don't want to take work home, right? And usually they even say, and also don't bring home to work. Like what most bosses say, whatever issues you're having in the house, don't bring them here. But it should also be the same thing. Whatever issues you have at work, you don't bring them home. So in your trading, you're supposed to ensure that whatever it is that has happened that day in your trading, you leave it in your trading day, the amount of hours that you've allocated for your day, you leave it there, and you proceed on to have a personal life. And that balance is very important, or else, you might find yourself self-destructing. We've had stories of people who, end up getting stressed and getting into depression in this white-collar industry of ours, of the financial industry. So it is important that you find that balance.
Yeah, and also another trader that sort of had the same philosophy as Anka when it comes to her trading hours. Anka also usually said, as a day trader, once the market opens, 2 to 3 hours, she's out. So we also had another trader called Ragi Hona. Ragi is I would say she's a nerd. She developed her own trading tool. It's called the grab and wave candle. And it is, she studied the principles of technical analysis from Charles Dow. And what I got from her is that you should, before you put any tool on your chart, you should really understand what you're doing. And she said, time and test, be discerning about the tools you use in your trading, what you put on your charts. And for her, she doesn't actually use trend lines, and that is okay because that is how she has designed her system. So just being able to understand exactly what tools you're putting is very important, so that it's not just something that you put up on your chart without really understanding what it is functioning for you. And in line with that, we had another, in terms of, now let's talk about tools and indicators. We had a mentee of Caroline Boroden. Her name is Tammy Marshall. And when you go to the interview video section, you just Google how to use Fibonacci analysis for stocks trading with Tammy Marshall. For her, as we summarize and try and summarize, for her, she said that setup plus trigger equals trade entry. So she's defining how she enters a trade position. So it is, for her, it is a setup. That setup, she has her own criteria, and you can go look up that interview to see how she identifies her setups. And basically, you need to know, in summary, what we're saying is that you can use the tools that are there on your trading system, but then again, you need to know what works for you. Not anything that works for all these interviewers that we've had in the past. You can borrow a few lessons from them, but you might find you're really tying with one person's strategy, or what is working for you, it doesn't work for another person, and that is okay. That is how the market gives us opportunities, and many opportunities for all of us cash in on that. So as we wind up, we also had my final comment. We had a Kenyan trader also, besides from Naomi, we had Sarjit Zinawi, and he's strictly an Elliott wave trader. And so when he was explaining, actually, I didn't know really the in-depth of Elliott wave. So he was talking about impulses and corrections and how the market moves in 5 waves. And to me, that was just, it was a wow moment for me, wow learning moment for me. So guys, I think as we summarize, please go to YouTube, Sylvia's Traders Lounge Forex channel. Google Sylvia's Traders Lounge Forex channel on YouTube. Everything that we have talked about is in there. And we welcome you guys to have, ask us questions. We will still be doing this webinar series next year. And we thank Scope Market so far for being our partners, for sponsoring all our webinars. We hope that you guys have been learning a lot from our guests. And we wish you all a Merry Christmas and a Happy New Year. So I will welcome final thoughts from Gilbert and Dennis as we wind up.
All right, thank you, Sylvia. Then maybe just also to mention a little bit about Sergey Zenawi. During that interview for wave analysis, we'd also want to give a shout out to him and also to thank him for having gotten the time to do that interview with us, because he's just recovering. He was sick and he did mention that to us, but he didn't want to let the audience down, and he did push through, and he was able to come and give us that wonderful presentation. So I'd also urge you to go and look at his video on trading the Elliott waves. And believe you me, like, these are the guys who, it's very rare for you to come across people who really mastered Elliott wave and Elliott wave theory. So if you're interested in that, it's kind of like an advanced form of Fibonacci, of trading using Fibonacci analysis. I would urge you to also look at that video as well. So thank you again, Sergey, for having had the time to make it for our interview. So my parting shot is, this was such an interesting year. COVID came in, that was a black swan event. And I remember Rita Brata talking about it's kind of like the thing that you're not able to factor in automated systems, and that's to do with black swan events, unforeseeable events. And you cannot tell how your strategy is going to react during a black swan event, because these unforeseeable events are different each time. So you're not able to tell. So this was quite a tricky year for trading, but all I can say is that for those of us who walked out in profits, all I can say is that, learn from that experience. For those who struggled out, reach out to people who can mentor you, right? If you're struggling with your trading, reach out to people who can mentor you. Look at our videos, join the Scope Markets trading community that's on the Telegram group. Let us build a community. Let us share whatever insights we have, whatever knowledge we have, because you cannot be a monopoly of information, right? There are people out there who know things that you don't know. So all I'd ask and urge you is reach out. Don't just be in a cave by yourself. Reach out to people, see what you can get from them. Also give back to the community as well. So if you haven't joined the Telegram group, kindly join the Telegram group. Let's start building a trading community together. And I'd like to thank Scope Markets as well for giving us the opportunity to bring these guests. Looking to have more guests next year. So guys, still continue tuning in on Fridays for these interview sessions. And to all our guests, even those ones that unfortunately we haven't been able to mention, but I think we've mentioned everyone. I'd like to thank you for having gotten the time to come and give your insight, give your knowledge to a wider audience, and maybe even a different audience, the African audience. So thank you, everyone, and thank you for tuning in.
Yeah, I think the only guest we haven't mentioned is, before Dennis summarizes, is Galena and David England. So Galena is an interesting one because she's a commodity expert and she also has her own brokerage firm. So please just, you can also go to our website for these webinars. That is forexstl.com. We also have articles there. We have training materials. You can subscribe to our website. You can send us questions if you have any. And we also have a link where you can open up your trading account with Scope Markets on that website. So Dennis, please, your 2020 wrapping.
Thank you everyone for taking your time and attending these webinars, and also for your contributions and your questions. Well, I will echo what my colleague has said, Gilbert has said, that this has been quite an interesting year for traders. And if it has been your first time to trade, count yourself as fortunate, because you have been exposed to the kind of volatility which other traders get to experience probably after 10 years when they start out their trading, or 5 years. COVID came out of nowhere, and we all managed to trade through it, profitably or not profitably, but I'm pretty sure you have learned a lot along the way. One of the guests that I would like to point out to is a quantitative trader, and he talks about having an edge, and specifically having a statistical edge when it comes to trading. As you begin your trading journey, you'll find that you will have a tendency to judge the outcome of your trading using one single trade. Take this time during the holidays to be able to go back to the trades that you did using a certain strategy. Review the performance, see whether you really had a statistical edge out of the number of trades that you took using that particular strategy. So this is the perfect moment to do that, because in fact, this is the reason being that this is the last busy week on the trading calendar. If you check out the Forex calendar, you'll see there is no much happening in terms of events. So this is the time to do that, to do the review. And another thing, for those who are aspiring to be short-term traders, this is the time to also give yourself what we call screen time. Look at those charts, look at the movements of price action. Try to familiarize your brain with them. And in the process, conduct back tests. And for those people who are not automated traders, you can also do your back tests. And I know it might look overwhelming when you're going back in time, looking at the charts, and because at the end of the day, that will be hindsight data that you're looking at and making assumptions that I would have done X, Y, Z here. But go to a site called FX Blue. You will be able to download a simulator, and then the simulator will be able to play back the market. See, using a particular strategy, might be a moving average strategy, might be using an indicator, might be levels of support and resistance. Play back the market, and the market will be playing back as if it's trading in real time. Then get to see how would you have approached that particular trade? Where would you put your stop loss? And then note all those moments. Create what I call a playbook. A playbook will be a series of setups that you have identified and that you have. And that means basically in the future, when you see price action setting itself in a particular manner, and because you have done your back test, you can simply be able to know that this is my setup. This is the kind of trade I go after. You can choose whether you want to risk 1% on that trade. If you have seen out of your back test that the probability of that trade working out is very high, it's not a must you risk 0.5%. You can risk 2% on that trade. You can risk 5%, depending on your risk appetite, knowing what you're doing. But knowing first of all before you execute, you have what we call a statistical edge. This is the moment to do all that. And to conclude, as the holidays approaches and as the year ends, liquidity tends to dry up. And when liquidity tends to dry up in the markets because participants are few, then that creates a good environment for volatility. And the kind of volatility that is really sharp. So watch out for that. Know that right now, as we head towards the holidays, that is the environment you're engaging in. So when you see wild swings, crazy swings, don't be so surprised. So that's all I have to say. Till next year. I hope for those who have been maybe demo trading, your goals for 2021 is to have some skin in the game, get to experience real market experience, but it doesn't matter for now. Congratulations for taking that step. Thank you, everyone.
All right, and the final words also from me, I would say it is important, as Naomi Wangari said, to work with a broker who is regulated. And in Kenya, look for a broker who has a stamp of approval from CMA, such as Scope Markets, because ultimately the safety of your funds, you cannot trade, it's that the livelihood of your trading capital. So just working and aligning yourself with a broker who you know is regulated is of utmost importance. So with that, we thank you all for your time. Until next year, goodbye. Goodbye from STL.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.